Welcome back to course number 4, Understanding Credit and Debt. In today's lesson, we'll examine how interest rates and minimum payments affect your debt. These two factors might seem small at first, but they have a massive impact on how long it takes to pay off debt and how much you end up paying in total. Interest rates represent the cost of borrowing money expressed as a percentage. For example, if your credit card has a 20% interest rate, you'll be charged 20% annually on any unpaid balance. The higher the interest rate, the more expensive your debt becomes. This is why carrying balances on high-interest credit cards can be so damaging to your financial health. Let's take an example. Suppose you borrow $1,000 on a credit card with a 20% interest rate. If you don't make payments, that balance will grow by about $200 in interest over 1 year. Now imagine carrying that balance for several years. It could easily double what you owe. Interest doesn't just add to your debt, it snowballs over time. Minimum payments are the smallest amount your lender requires you to pay each month to keep your account in good standing. They might be as little as 2% of your balance. While making minimum payments avoids late fees, it does very little to reduce your debt. In fact, paying only the minimum allows interest to pile up, keeping you in debt for years. Let's go back to the $1,000 example. If your card requires a 2% minimum payment, that's about $20 per month. If you only pay the minimum and your interest rate is 20%, it could take you more than 5 years to pay off that $1,000. And you might pay over $500 in interest on top of the original balance. What started as $1,000 ends up costing you $1,500. That's the power of interest combined with minimum payments. This system benefits lenders because minimum payments keep people in debt longer, generating more interest for the bank. That's why credit card companies encourage minimum payments. From a borrower's perspective, it feels manageable in the short term, but it creates long-term financial stress. So how do you avoid this trap? First, always aim to pay more than the minimum. Ideally, pay your balance in full each month. Second, focus on paying down high-interest debt first, a strategy often called the avalanche method. Third, consider consolidating debt into lower-interest options, like a personal loan, if you're struggling with multiple balances. Even small extra payments, like adding $20 or $30 above the minimum, can save you hundreds of dollars and shorten repayment time dramatically. Imagine two students, Taylor and Chris. Both have $1,000 in credit card debt at 20% interest. Taylor pays only the minimum each month, while Chris pays $100 each month. Taylor ends up taking over 5 years to pay off the debt and pays hundreds in interest. Chris pays it off in about 11 months with much less interest. This shows how your repayment choices directly shape your financial outcomes. To sum up, interest rates and minimum payments are two key forces that affect how debt grows. High interest and small payments can trap you in debt for years. By paying more than the minimum and understanding how interest works, you can take control of your financial future. This concludes our discussion about the impact of interest rates and minimum payments. In the next lesson, we will learn about the risks of high-interest debt. See you then.